Welcome back to another session. This is Pinnacle Professional College. We provide you world-class education and lectures when it comes to everything related to accounting and audits. If you haven't subscribed to the channel, please do so. You would love our content. Just hit the subscribe button, hit the notification bell, which is the bell icon that's marked with the red, highlighted red here. So hit the bell icon so that anytime we post a video, you'll be the first to get it. You can find us on Telegram, you can find us on Facebook, you can find us on Instagram. Please follow us there, like our page, and comment on our page. Now, today we'll be talking about audit testing. Now, we cannot talk about audit testing without talking about audit evidence. We test based on the evidence. So testing cannot be done without gathering audit evidence. It's extremely important. So the outcome of an audit is a report. Out of every audit, there's the outcome is a report, which usually expresses an opinion. The content of that report and the auditor's opinion may subsequently be challenged. So it's possible for the content of that report to be challenged. If this happens, the auditor must be able to justify what he or she has written. And so that's where evidence comes in. The report and opinion must be supportable by the auditor. So if the opinion must be backed by some evidence, otherwise, how do you reach your conclusions as an auditor? You cannot reach your conclusions as an auditor just by a blanket statement saying that this is a qualified or unqualified opinion. There has to be evidence. So that's very, very important. So that's where evidence comes in, and the gathering of evidence comes in relation to audit testing. Now, what is audit evidence? It is simply any information used by the auditor to arrive at the opinion. It's the information the auditor uses to arrive at the opinion. So to arrive at an opinion or a conclusion, the auditor has to base it on some hard facts. There has to be an opinion. Very, very important. Very, very important. It includes information in the accounting records and other information. The auditor carries out procedures known as audit tests. In order to create this evidence. So that's where we have the whole testing. If you've heard the term testing when it comes to audits. These tests could be test of control, that is internal control testing. They could be test of detail. You can also call it substantive testing or test of transactions and balances. It is also unlikely, very, very important, please take note of this. It's unlikely that the auditor's test will be applied to all the transactions that have been undertaken. One of the important things in auditing is sampling, because there are lots of transactions that organizations have within a year. So many transactions, and it is not necessarily cost and time efficient for an auditor to test every single transaction. So the audit evidence will typically be drawn from a sample of transactions. So this is very, very important to understand, because this is the foundation of understanding audits. The auditor does not test every single transaction. The auditor deploys sampling techniques to sample, out of the entire population. And so that's why there are terms used such as, reasonable assurance. The auditor provides a reasonable assurance because the auditor does not give absolute assurance. He cannot give absolute assurance because they do not test every single transaction. They don't do that. They don't do that. So that's very, very important to understand. Now, this audit evidence, right, must be what we call sufficient and appropriate. Sufficient and appropriate. Sufficient relates to the quantity of evidence. Sufficient. There must be enough. The audit evidence must be enough to support the auditor's conclusion or opinion. It must be enough. The audit evidence must be enough. Appropriate relates to the quality, of the evidence. So you have quantity, which means sufficient. You have appropriate, which relates to the quality. Quality in terms of relevance and reliability. So you see, it should be sufficient and appropriate. Quality, quantity. The auditor will need to exercise what we call professional judgment on both of these aspects. So when it comes to the whole audit evidence thing, the auditor exercises professional judgment in deciding whether there is enough evidence. So the auditor uses his or her professional judgment to decide whether this audit evidence is both sufficient and appropriate. Is it enough, and is it, of a good quality to qualify as audit evidence? So the auditor will determine when is there enough evidence to support a conclusion and what is the quality of a given piece of evidence. Very, very important. The two characteristics of quantity and quality are also interrelated. They go hand in hand, right? An auditor may be able to reach a justifiable conclusion based on a similar quantity of high quality evidence. So quality, quantity, you cannot take one and leave that. They kind of like go hand in hand. So there are factors that influence the sufficiency of audit evidence. Number one is the materiality of the item being tested, the financial position, right? Materiality, sufficiency, quantity. So they go hand in hand. The condition of the accounting and internal control system, that will determine the sufficiency of the evidence. If the internal control systems are good, you might not need plenty of evidence. But if the internal control system is terrible, then what is sufficient may be a greater quantity of audit evidence. They also have persuasiveness of the audit evidence. If the audit evidence is persuasive, it also influences or impacts sufficiency. Very, very important. These are important points that you need to certainly keep in mind. Now, let's talk about the reliability of audit evidence. Reliability relates to quality and relates to appropriateness. There are a number of general principles set out in ISC 500 to assist the auditor in assessing the reliability of audit evidence. These can be summarized as follows. So audit evidence is reliable, is seen as reliable when it is obtained from independent sources, right? So when you get the bank balance of a client from the bank itself or from the bank of that client, because it's coming from an independent source, it's seen as more reliable. Guess what? If you ask your clients, how much you have in your bank, and they say 100,000, compared to them saying 100,000 compared to their bank actually giving you their bank balance, which one is more reliable? What is more reliable is their bank giving you the bank balance because it's coming from an independent source. Audit evidence obtained directly by the auditor is more reliable than audit evidence obtained indirectly. So audit evidence that is obtained by the auditor is more reliable rather than obtained indirectly. Audit evidence is also reliable when it exists in documentary form. When it's documented, audit evidence is provided by original documents. It's more reliable than audit evidence provided by photocopies. So we want original documents rather than photocopies. I guess that makes a whole lot of sense. Now, let's talk about, we cannot talk about audit testing without talking about procedures, audit procedures. A number of audit testing procedures are available to the auditor as a means of generating audit evidence. We cannot talk about audit evidence, audit testing without talking about audit procedures. More than one procedure may be used in collecting evidence in a particular area, and not all procedures may be appropriate to a given objective of the audit. Now, there are 7 main testing procedures for gathering audit evidence, 7 main audit procedures or testing procedures. Number 1 is inspection. Please, these 7 procedures are extremely important, so please do well and follow me carefully. Number 1 is inspection. So you can inspect documents. You can also observation. Observing an inventory count, for example, is an example. You have inquiry. So inquiries, it means asking, to ask, somebody who can give you the information you want. So inquiring from management is a typical example. External confirmation. External confirmation, what does it mean? Confirming a balance or a transaction, with an external party that the client has a relationship with one way or the other. You have recalculation, basically recalculating how something has been computed by the client, right? So you can recalculate, maybe the client calculated their revenue in a certain way. You can recalculate it. You have reperformance. Reperformance is performing a procedure that has been undertaken by the client. Reperforming it, that means you are doing it again. You are reperforming a procedure. You are performing a procedure that has already been done by the client. Just to understand how the process works. They have analytical procedures, which is basically analysis, right? Analyzing. So a typical example of analytical procedure would be comparing this year's revenue number to last year's revenue number to understand the differences and why those differences exist as an analytical procedure. So these 7 testing procedures are very, very important. Inspection, observation, inquiry, external confirmation, recalculation, reperformance, analytical procedures. Now, there's an acronym I like to use, which is RARE IOI. RARE RIOI. So RARE, RARE, which is rare, and IOI. So you can decide to use that if that works for you. Now, let's talk a little bit about financial statements assertions. We will lay the foundation on that and we will touch on that in subsequent sessions. Modern auditing theory takes the view that the financial statements are made up of a number of assertions. These assertions are claims or representations. So for example, if you say the revenue balance is 5 million, you are making a claim. So the auditor should therefore generate evidence designed to reach a conclusion about each of these assertions. These assertions are set out in ISA 315 and fall into 2 categories. ISA 315 and fall into 2 categories: assertions about classes of transactions, which in other words, they are called income statement assertions, and assertions about account balances, which are statements of financial position assertions. So you have 1, your income statement assertions, and you have 2, your statement of financial position assertions. So these are the 2 main classes of assertions. And this is where we would bring this lecture to an end. Thank you for listening. We'll talk about a lot more about session in subsequent videos. Thank you very much for listening. If you haven't joined our Telegram group, do so. It's Pinnacle Professional College. Thank you for listening and have a good day. Bye.